Hello, welcome to Chapter 7, Company Formation and Financing. This is probably one of the longest chapters, so I apologise if it goes at quite a pace, but there's a lot to get through in this chapter. We are talking global variant of F4, but when it comes to company law, the syllabus, I'm afraid, is primarily based on the UK Companies Act 2006. There are plenty of important topics, some basic stuff like how to file, documentation, what's needed. It's very wide little area. From an exam point of view, your main concern is limited liability companies, where the liability of a member for the debts of that company is limited to the amount they've invested in shares. Okay. You should also be aware that it is possible to have unlimited companies, so the liability is not limited, but that's pretty rare. And there is also a case where companies can be limited by guarantee. In other words, shareholders actually haven't put the money in, but they guarantee to put money in should the need arise. When dealing with this section of the syllabus, it's also important to note a distinction between private companies, where the name ends limited or Ltd, and public companies, where the name ends public limited company or PLC, as the rules for each type are different. And the key point to note is that public companies are more stringent rules, as simple as that, which, for example, the level of distributions, what they can have as distributed profits, the rules are much more stringent. Please also note that a listed company must be a public company, but that a public company is not necessarily a listed company. Okay, now that may sound a bit quirky, but you can actually be a public company due to your size, but you don't necessarily have to be listed on a stock exchange in America, London, wherever. Okay, you will also need to think back to your studies of agency law, which is a chapter we looked at earlier, where a director of a company would normally act as an agent for the shareholders. The promoter of a company will effectively be treated as an agent as well. They're the people who set up the company. A very important concept to grasp is that a company as an incorporated body is a separate legal entity. Okay, as first established by the case of Solomon v. Solomon. We'll look at veil of incorporation in a minute. Now, key distinctions between private and public. You need a trading certificate before you can start trading. Minimum capital, yes, 50,000. Public issue allowed, yes, if you're a public company. Minimum members, minimum directors, again, citing 2 people. Compulsory company secretary. AGM is always required. Audit requirement compulsory. Distribution rules, yes, there are some restrictions. You need to file your accounts 6 months, not 9 months, so you have to be much quicker on your filing. Right, the veil of incorporation, as I said earlier, you have separate legal identity. So under normal circumstances, the members and officers of the company are protected behind what is known as the veil of incorporation. In other words, you don't know what's behind it. However, you need to be aware that the veil can be lifted as shown by the following table. So if you're in this scenario, then the veil of incorporation can be removed due to this occasion, okay, this reason. Company promoters is a person involved in the formation of a company other than when acting in their normal professional capacity, e.g. a lawyer. Promoters have a general duty to exercise reasonable skill and care in undertaking their work. Unless the promoter will wholly own a new formed company, he has agent's responsibilities to others subscribing for shares, and in particular must avoid conflicts of interest, fully account for all the benefits they've received and not make any secret profit. You should note carefully that pre-incorporation contracts entered into on behalf of the company cannot be ratified, i.e. that it wasn't capable of being able to do an offer and acceptance. They're not legally binding. The company did not exist. Okay, so watch for that in a practical scenario type question. Company formation is achieved when the Registrar of Companies issues a certificate of incorporation. Until it's like a birth certificate. You need to register your documents together with the appropriate fee of currently £20. So not a huge amount of money. You do this online, takes not very long at all. What do you need to get? Well, registration application, memorandum of association, which is basically details of those who agreed to be the first members of the company. Articles talks about how you're going to operate, etc. So there's a few things you need to have an understanding of definitions. A private company may begin its business activities as soon as it receives its certificate of incorporation. You can get going. Before a public company may legally begin its business activities, it must, in addition to this certificate of incorporation, obtain from the Registrar of Companies a trading certificate. So you need a little bit more. But what this will have will show that share capital is not less than £50,000. It will detail the formation expenses, i.e. how much it costs to form the company, and a statement of compliance. Company constitution we talked about, but basically there are two documents, although this has now become one as a result of the Companies Act 2006. So the Memorandum of Association is no longer as important. It's basically an historical document produced at the time of registration, and that's it. The Article of Association is the important document. It contains things that were in the memorandum and is essentially a set of internal rules directing powers of the directors in how they can run the company. You can alter articles by passing a special resolution, which is 75% majority of the people able to vote. These provisions protect minorities. The courts, however, will always go in the best interest of the company as a whole. It is a contract between two parties and they are legally binding. Objects clause. The clause traditionally sets out the activities of the company, what they're able to do, whether it's sailing, building ships, whatever. But under the Companies Act 2006, a company with unrestricted objects will be the situation unless the company decides to do otherwise. Now, the reason why you need to know about your objects is because if you act outside of your objects, it could be deemed to be ultra vires, which would mean that the members could take action against the director for being in breach of their authority because they've gone outside the objectives of the company. Name clauses. All companies are required by law to have a unique name, which must not normally end limited or which must normally end with the words limited or public limited or the abbreviations. Your names must comply with certain rules, i.e. it can't be any of the following, which are fairly obvious. Perhaps the last one, passing off, is pretending to be something that you're not. So having a name that sounds like Coca-Cola or McDonald's would be passing off. Share capital, you must define as the interest of a shareholder in the company measured by a sum of money. There are three different types: issued and allotted, called up and paid. Issued and allotted means it's been issued and actually given to a shareholder. Called up share capital could be higher than that, just hasn't been issued. Paid up means the shareholder has paid up their entitlement. You need to work out the difference between the ordinary and preference shares. when it comes to voting rights, dividends and repayment of capital on a liquidation. It's important to see the differences between the two. In your studies, you should also give some consideration to the following issues: issuing allotment shares, redeemable shares, variation of class rights, loan capital. Key point is to note is that holders of loan capital are creditors of the company and not shareholders. They're not members. So if a company is looking to raise long-term capital, a company will often issue what is known as a debenture. It's a bank loan by another name. Three main types of debentures: single debenture, debenture series, debenture stock. Most commonly seen as being issued with security because they create a legal charge over one or more of the company's assets. So it's like a mortgage secured on a property. If you are having a charge, you have priority should the company fall into liquidation. There are two main types of charge, and you need to note these carefully because they do rank differently. If you have a fixed charge, that ranks ahead of a floating charge. What is a fixed charge? It's related to a specific asset, whereas a floating charge floats over general assets. Okay, relates to a group of assets and not one in particular, so it's not as secure. If there is more than one charge on the same asset, then the general rule to note is that charges will normally rank in the order in which they are created, provided they are registered in time, 21 days. Fixed charges will all rank before floating charges, i.e. they get their money first. As an exception to the above, a floating charge which contains a negative pledge clause may rank before a fixed charge created subsequently, provided its existence is communicated to the holder of the latter fixed charge. So a floating charge with a negative pledge clause can rank ahead of a fixed charge holder as long as they knew about it. Charges may be registered with the Register of Companies, but details must also be held in one of the company's statutory books, known as the Register of Charges. And to be honest, you can sometimes get a question along that line. There is a general assumption that companies should not be allowed to make payments out of capital because this would restrict the payments to third-party creditors. There are potential examination questions that concern relate to reduction of share capital and distribution of dividends. There are a number of ways a company might want to do this, and that would be to eliminate the retained losses, liabilities to partly paid shares, or return capital no longer required. So it is possible to reduce share capital. But to do that, you need to have authority to do so in your articles, you need to pass a special resolution, and you need to obtain a court sanction. Distribution of dividends. The basic rule is that no company may pay dividends otherwise than out of profits available for distribution. For a private company, this is taken as excess of accumulated realised profits over accumulated realised losses. Hopefully from your accounting knowledge you'll know this. For PLCs, there is a further restriction, however, in that they may not make any distribution unless at the time the company's net assets are not less than the aggregate of its called up share capital and undistributable reserves. Okay, so basically what this does is any accumulated unrealised loss will come off the profit available for distribution. So it's slightly more onerous, but that's the joys of being a PLC. Okay, sorry about that. It was a bit of a canter through chapter 7, but hopefully that's outlined the express notes, and I'll see you in chapter 8.